You know, we always picture the Federal Reserve as this giant, powerful institution. But what if I told you that the direction of our entire economy might actually boil down to just one person, the Fed chair? That's what we're digging into today. How much power does that one individual really have? So let's get right to it. Does it really matter who's running the Federal Reserve? I mean, you've got all these committees, tons of data, super smart economists. You'd think the person at the top is almost secondary, right? Just a figurehead for the institution? Well, what if that's totally wrong?
Actually, the research is pretty clear on this. This appointment, it's one of the most powerful, most market-moving decisions in the entire world. We're not just talking about making the evening news. The choice of who becomes Fed chair can literally move trillions of dollars around the globe. And we can measure.
Okay, so Section 1, one person, trillions of dollars. And the subtitle here is The Myth of the Faceless Institution. Let's just bust that myth right now. History's full of examples. I mean, think about Alan Greenspan. His name was U.S. monetary policy for decades. Or, if you want to go way back, look at Benjamin Strong. Some historians actually argue that his death back in 1928 helped trigger the Great Depression. So yeah, the person in that chair, they definitely matter.
But hey, you don't have to just take my word for it or rely on these historical stories. We've got hard data. A really fascinating paper from the National Bureau of Economic Research, you'll hear people call it the NBER, they looked at this exact question. They measured what happens to the markets in the very moments after a new Fed chair is announced. And what they found is super interesting. It all comes down to one thing: surprise. See, if everyone expects a certain person to get the job, when the announcement finally happens, nothing. The markets barely shrug. Why? Because that news is already priced in, as they say. But when the choice is a total surprise, that's when things go wild. You see these huge, measurable reactions. It's a classic case of efficient market theory in action. Markets only react to stuff that don't already know.
So, you're probably wondering, how big of a reaction are we talking about here? Well, that NBER study found that a typical surprise announcement can cause about a 1.1% swing in exchange rates. Now, I know what you're thinking. 1.1%, that doesn't sound like much. But trust me, in the world of currency trading, where trillions of dollars are flying around every single day, a 1.1% move isn't just a ripple, it's a financial earthquake.
And this idea of a chair's personal influence, well, it leads us right to maybe the most famous example of all time, the legend of the Greenspan put. This was this powerful, widespread belief that Alan Greenspan, the Fed chair, had basically created an invisible safety net under the stock market.
Now, a legend like this doesn't just appear out of thin air, right? It was built over time, event by event. It really kicked off with the Black Monday crash in 1987, which happened right after Greenspan took the job. The market tanks, and boom, the Fed jumps in and pumps in liquidity. Fast forward to '98, a huge hedge fund collapses, threatening the whole system. What does the Fed do? They cut rates. Then in 2001, the dot-com bubble bursts, and again, the Fed steps in to ease policy. You see the pattern here? Every time the market got into big trouble, the Fed came to the rescue.
So naturally, investors started connecting the dots. They saw this pattern, and it created this idea of, well, an unspoken insurance policy. In finance, a put option is something you buy to protect yourself if a stock goes down. So the market came up with this nickname, the Greenspan put. It was this belief that you didn't need to buy insurance, because the Fed itself would always step in and cushion any big fall.
And look, this wasn't some crazy conspiracy theory whispered in the corners of Wall Street. This idea became totally mainstream. So much so that by January 2001, the Financial Times, one of the most respected financial papers in the world, flat out said, quote, "It's official. There is a Greenspan put option." That tells you everything you need to know about how deeply this belief was baked into the market's thinking.
Okay, so as you can imagine, this whole thing kicked off a massive debate that's still going on. Was the Fed basically just bailing out Wall Street, or was this all just a side effect of them doing their job and running good monetary policy? Let's look at both sides of the argument.
All right, in one corner, you've got the bailout argument. The people here say this created what's called moral hazard. Basically, it told investors, go ahead, take crazy risks. If it all goes wrong, don't worry, the Fed will be there to save you. But in the other corner, you have the good policy argument. These folks say, hang on, the Fed's main job is to keep the whole economy stable for everyone. A huge stock market crash can be a warning sign of a recession, and it makes zero sense to let the entire economy sink just to, teach speculators a lesson.
Okay, so we can argue all day about why the Fed did what it did. We can debate their intentions. But you know what's not up for debate? The data. The numbers are crystal clear. A study from 2020 looked back and found a very distinct pattern. Ever since the mid-1990s, whenever the stock market drops by 10%, it's typically followed by the Fed cutting interest rates by an average of 1.2 percentage points over the next year. So whatever the motive was, the reaction, the pattern, it's absolutely real.
So why are we talking about all this history? Why does any of this matter to you right now? Well, because the past is often the best map we have for the future. And believe me, a very big change is coming up on the horizon.
Here's the deal. The current Fed chair, Jerome Powell, his term is up in May of 2026. That's not very far away. A new leader is going to be chosen, and as we've just spent the last few minutes seeing, that one single choice isn't just political news. It could have huge, direct impacts on the economy, on policy, and, yep, on your money.
I mean, just think about the ripple effects for a second. Let's say we get a new chair who leans towards lower interest rates. What happens? Well, bond prices usually go up. Stocks often get a boost because borrowing is cheaper for companies. For you, personally, your mortgage or car loan could get cheaper, but the interest you earn in your savings account, that's probably going down. Even things like crypto can get a tailwind. Literally every single part of your financial life is connected to this one decision.
So, that leaves us with a really big question, doesn't it? The next person to take that chair is walking into a world with totally new challenges. We're talking AI, we're talking digital currencies, stuff Greenspan never had to think about. So, will they follow the same old playbook? Are we about to meet the next generation of the Fed put? And in an economy that's changing this fast, what would a new put even look like? It's something to think about as we all wait for what is, without a doubt, one of the most important appointments in the entire world.